Could China be preparing to deploy an economic nuclear option? This question has been on the minds of economists worldwide. The term nuclear option in economic parlance often refers to a drastic measure such as a significant currency devaluation, which can have far-reaching global implications. Recently, China's activities have raised eyebrows across the globe. The country has been buying up commodities like gold and oil at an unprecedented rate. This rapid accumulation has led some analysts to speculate whether Beijing is preparing for a major economic maneuver. The CEO of Steno Research, Andreas Steno Larsen, recently suggested that China might be preparing for a one-off devaluation of their currency, the yuan. Such a move could potentially boost China's exports by making its goods cheaper and more competitive, but it would not be without serious global repercussions. As China continues to stockpile important resources, the world watches and wonders, is a major currency devaluation on the horizon? Currency devaluation, or the economic nuclear option, carries serious global repercussions. Here's the thing. When a country intentionally devalues its currency, it's not a decision made lightly. It's like playing chess on a global scale, and every move has to be carefully calculated. Let's take China as an example. If China were to devalue the yuan, it could potentially boost its exports. How? Well, by making its goods cheaper and more competitive on the global market. It's a simple equation, really. Lower the value of your currency, and suddenly, your products become a bargain. This could give China an edge, especially as it seeks to expand its industrial footprint in international markets amid deflation and insufficient consumer demand domestically. But here's where the plot thickens. While this move might be a boon for Chinese exporters, it could stir up a hornet's nest of trouble with trade partners. Countries that import Chinese goods could see their own industries suffer as they struggle to compete with cheaper imports. This could lead to job losses and even economic downturns in those countries. And let's not forget the elephant in the room, the ongoing trade war with the United States. A move like this could add fuel to that fire. Already, Chinese industries are being accused of flooding markets with low-cost exports like steel and chemicals, and the US and European Union are considering tariffs on China's electric vehicles. So let's sum it up. On one hand, devaluing the yuan could stimulate China's export sector and potentially bolster its economy. On the other, it could lead to increased tensions with trade partners and exacerbate existing geopolitical conflicts. The economic nuclear option is indeed a double-edged sword. China's strategic accumulation of resources like gold and oil could provide some financial security in the face of potential negative effects of a devaluation. Let's delve into the specifics. China's central bank has been on a gold-buying spree, boosting its reserves of the precious metal for 17 straight months. This is happening despite gold's sky-high price and the weak yuan. It seems the allure of gold's stability and the desire to diversify assets in the midst of geopolitical tension is too strong to resist. Eswar Prasad, a Cornell University professor and former International Monetary Fund official in charge of China, shines a light on this strategy. He points out that official gold purchases reflect a desire to diversify foreign exchange reserves away from the dollar and other Western currencies. But it's not just gold that's catching China's eye. The Dragon Nation is also voraciously stockpiling crude oil. China, already the world's largest importer of oil, ramped up its purchases to a staggering 11.3 million barrels per day last year. To put this into perspective, that's a 10% increase over the previous year. The end of strict pandemic-era restrictions resulted in a spike in fuel demand, explaining part of this rise. But it's hard to ignore the strategic implications of this stockpiling. China's no-limits partnership with Russia, last year's largest petroleum exporter to China, is a key factor. This partnership helps secure a reliable and discounted flow of energy, while simultaneously propping up Moscow's isolated war economy. The accumulation of these resources paints a picture of a nation preparing for potential economic turbulence. By stockpiling gold and oil, China is creating a buffer, a safety net of sorts, should the potential negative effects of a devaluation come to pass. It seems China is fortifying its economy against potential shocks. China's economic strategies can't be separated from the larger geopolitical context. With the world's focus shifting between the East and the West, China's recent economic maneuvers are not just isolated incidents. They are part of a broader geopolitical strategy. Let's look at China's gold buying spree. 17 straight months of boosting gold reserves, despite a weak yuan and record high prices of the precious metal. This move is not merely financial. It's a geopolitical chess move. By accumulating gold, China is diversifying its assets away from the dollar and other Western currencies. This is an effort to insulate China's economy from geopolitical tensions, especially with the United States. Meanwhile, China's growing oil imports are another piece of the puzzle. China is already the world's largest importer of oil, but its appetite for the black gold is growing. The country purchased a record 11.3 million barrels per day last year. This increase came as China lifted its strict pandemic-era restrictions and demand for fuel spiked. But there's more to this story. China has leveraged its no-limits partnership with Russia to secure a reliable and discounted flow of energy. Russia, in fact, last year supplanted Saudi Arabia as China's largest petroleum exporter. This partnership not only helps China secure its energy needs, but also aids Russia's war economy, which has been isolated due to geopolitical tensions. These moves, the gold buying spree and the growing oil imports, they're not just about economics. They're about China's place in the world, its relationships, and its strategic maneuvers on the global stage. Geopolitics and economics are two sides of the same coin for China. While devaluation might be tempting for China, it would inevitably escalate tensions with Washington and other major trade partners. The economic nuclear option of currency devaluation is not one without consequences. It's like shaking a hornet's nest. The repercussions can be stinging and long-lasting. One of the most immediate impacts would be the backlash from major trade partners. Already, Chinese industries are facing accusations of flooding markets with low-cost exports. This is particularly evident in sectors like steel and chemicals. A deliberate devaluation of the yuan would only add fuel to these allegations, leading to a potential rise in trade disputes. Moreover, such a move could prompt investigations and retaliatory actions from other economies. For instance, both the United States and the European Union are already considering imposing tariffs on China's electric vehicles. This could significantly impact China's aspirations to dominate the global EV market. But it's not just about trade relations. A devaluation could also worsen the country's trade war with the United States. As we know, trade wars are rarely confined to the economic realm. They often spill over to affect diplomatic and geopolitical relations as well. While China's stockpiling of resources could provide some financial security in the short term, it does not negate the potential long-term impacts of a devaluation. These might include increased import costs and inflation, both of which could put a strain on the domestic economy. In addition, there's also the risk of triggering a global currency war. If China devalues its currency, other countries might follow suit in order to maintain their competitive edge. This could lead to a vicious cycle of devaluations, destabilizing the global economy. Devaluation is a risky gamble, and the stakes are high. There's no doubting the potential benefits for China in the short term, but the long-term repercussions could be far-reaching and damaging. As the saying goes, one must be careful when playing with fire. China's economic strategies and potential nuclear option have kept the world on its toes. The nation's rapid accumulation of commodities like gold and oil, seen as a financial buffer, has raised eyebrows and sparked speculation. Are they preparing for a major one-off devaluation of the yuan, an economic nuclear option with grave global repercussions? This potential move could boost China's exports by making its goods cheaper, but it's not without its drawbacks. It could incite trade partners, exacerbate the trade war with the United States, and lead to increased import costs and inflation. Meanwhile, the geopolitical context adds another layer of complexity. China's efforts to diversify assets amid tensions with the US and its strategic partnership with Russia are all pieces of this intricate puzzle. While the private sector's growing holdings of gold bullion and jewelry may be driven by domestic policy risk, China's steady accumulation of raw materials also extends to crude oil. The country's record purchases of oil, a 10% increase over the previous year, could be a strategy to secure a reliable, discounted flow of energy. As we keep a keen eye on China's economic maneuvers, it's clear that the economic landscape is evolving and the consequences will be felt globally.